Make your next move with American Express Business Platinum. You'll get 5 times membership rewards points on flights and prepaid hotels booked on AmexTravel.com. Plus, enjoy access to the American Express Global Lounge Collection. And with the welcome offer of 150,000 points, your business can soar to all new heights. Terms apply. Learn more at americanexpress.com/business-platinum. Amex Business Platinum, built for business by American Express.
Hello, listeners. Welcome to the Credit Compass, the podcast that helps you navigate the world of European credit. I'm Gordon Kerr, European macro strategist and host, and today we are diving into several fascinating developments shaping the credit landscape in 2025. We'll explore the results of the latest International Association of Credit Portfolio Managers, or IACPM, Credit Outlook Survey, unpack the European Central Bank's January 2025 Credit Conditions Survey, plus some corporate distress indicators, as well as examine how private credit is adjusting by climbing the credit curve and ramping up distressed debt management efforts. Let's dive right in. The IACPM's recent Credit Outlook Survey gives us a critical glimpse into the views of credit portfolio managers around the globe. For those unfamiliar, the IACPM surveys its members, who manage trillions in credit exposure, largely banks and insurance companies, among others, on forward-looking credit conditions, risk appetite, and emerging market concerns. The January 2025 release of the Q4 survey results indicates a cautious stance, with the majority of respondents forecasting a deterioration in corporate credit conditions, especially in leveraged loan markets. What's driving this sentiment? In our view, it is one word, which we are all feeling this week: uncertainty. Inflationary pressures have moderated somewhat, but geopolitical risks, energy price volatility, and uneven growth across developed markets have amplified credit risk concerns. Added to that, we now have the recent uncertainty of AI, with the disruption to the industry by DeepSeek, and the added impact of the Trump administration. Anyway, back to the survey. Interestingly, participants flagged increased attention on sector-specific risks, particularly in real estate and retail, sectors that are still grappling with pandemic-era disruptions and structural changes. Looking into the European angle of the survey results, a larger proportion of respondents predict a widening of European market spreads. For investment-grade credit, this was a big increase from the Q3 2024 results. More than 60% expect a widening in both the iTraxx European Main Index as well as the iTraxx European Crossover Index. Further, when looking at credit defaults, more than 50% expect an increase in defaults over the next 12 months. The highest proportion expect this to be focused on European corporates. This aligns with the sentiment that came out of Davos's World Economic Forum last week, where a number of attendees highlighted a seemingly very negative sentiment for Europe. However, so far this year, both credit indices have had a tightening bias, albeit marginal. While there's no full-blown panic in the survey results in comparison to the results from recent incidents like the pandemic period and Russia-Ukraine, risk aversion is evident, with the focus of greater concern on European credits. Credit spreads are expected to widen, defaults may tick higher, and managers are more focused on proactive risk management, such as reducing exposure to lower-rated credits. This sets the stage for a very different credit environment in 2025, at least in the first quarter, while Europe adjusts to its growth troubles, and adding to that, the impact of President Trump. It is here that private credit players are uniquely positioned to step in, but more on that later. Now, let's turn to the European Central Bank, which released its January 2025 Credit Conditions Survey a little over a week ago. This report serves as a barometer for lending dynamics across the Eurozone. The big picture? Credit conditions have tightened for both firms and households. Banks cite higher funding costs, increased risk perceptions, and regulatory constraints as the primary reasons. As we've mentioned earlier, credit portfolio managers at banks and large insurers are concerned about Europe, supporting this tightening of conditions. Lending to small and medium-sized enterprises has seen the sharpest contraction, reflecting a cautious approach among lenders to segments perceived as more vulnerable to economic headwinds. On the demand side for loans, particularly in the corporate sector, also showed a notable decline. Borrowers are hesitant to take on new debt given high interest rates and an uncertain macroeconomic backdrop. However, there is a silver lining here. The green transition continues to spur demand for financing in energy, infrastructure, and technology sectors tied to sustainability initiatives. This is a key pillar of growth for Europe as the transition away from external energy reliance continues. For investors and credit market participants, the survey underscores the importance of differentiating between sectors that are struggling versus those thriving in this high-rate, tighter credit regime. Supporting this theme of elevated interest rates and their impact on small and medium-sized enterprises, there have been 2 reports out recently on the relative health of European and UK corporates. Wales' European Distressed Index shows that European corporate distress levels remain above the long-term average, but they have stabilized at this elevated level. In other words, things are not getting worse, but they aren't exactly getting much better either. The most distressed sectors are industrials, followed by real estate, and then retail and consumer goods. Germany was the most distressed market in the report, followed by the UK and France. In the UK, Begbie's Trainer Group's Red Flag Alert further supports the conclusions of the Weil report, as UK businesses also face a difficult trading environment. In the fourth quarter, businesses in critical financial distress increased 50% over the third quarter. In particular, consumer-facing businesses are bearing the brunt as we enter 2025, followed by the construction and real estate sector. And they are not helped by the Labour government's planned minimum wage and tax increases. Added to the UK's troubles, the GfK Consumer Confidence Indicator for the country declined in January, after showing some signs of improvement in the prior several months. This does not bode well for the first quarter, as both the UK and Europe continue to struggle with growth. However, to bring a little light to the gloom, at Davos last week, Larry Fink, the CEO of BlackRock, told Bloomberg in an interview that the conference was so negative on Europe, it might be time to invest and play the counter-sentiment trade for 2025. He may be right. The European stock markets have outperformed US equity markets so far this year. Euro Stoxx 50 is up roughly 6%, the CAC 40 is up over 7%, and the DAX is also up 7%, and the FTSE 4%. Comparatively, in the US markets, the Dow Jones is up only just over 4%, the S&P around 2%, and NASDAQ is flat and falling thanks to the recent hit to the Magnificent Seven, at least as of the recording of this podcast. However, we aren't even through the first month of the year. From a credit market perspective, it is still could be a rocky road to growth, and Q1 is looking to be under pressure. Supporting the equity market picture and providing some much-needed relief to UK and European corporates is a virtually baked-in rate cut from the ECB this week, and a likely cut in the UK on the 6th of February. This should be helpful to those businesses under duress and may even support Larry Fink's Davos counter indicator later in the year. For now, it is important to be vigilant and focus on credit performance. Now, let's turn to the private credit market, which has been a rising star in the fixed income world. But it will be tested alongside other leveraged markets in 2025. 2025 will definitely test its adaptability. Banks and the Trump administration are fighting back against regulations that have allowed private credit to flourish. A regulatory pullback appears to be on the cards, as we mentioned in our podcast last week. A recent key theme of private credit markets is a transition to broaden and increasingly target higher quality credits, such as upper middle market companies and investment-grade adjacent borrowers, as well as asset-backed finance, the bread and butter of banks. This is an expansion from predominantly high growth, higher risk, and longer duration lending. Why is this happening? Well, as we see it, there are largely 2 reasons. One, the growth of the private credit market over the past several years has been so strong and rapid as rates and yields have increased that the market needs to expand to efficiently deploy capital into new income streams. And secondly, investors now demand better quality names as a compensation for the higher for longer interest rate environment that we now face and the risk of recession. And as a result, a need to adjust risk profiles, so they are climbing the credit curve. similar to the managers in the IACPM survey. At the same time, another trend is emerging, a hiring spree in distressed debt management among private credit managers, according to a recent Business Insider article. With default rates and financial stress elevated, particularly in sectors like retail, real estate, and consumer sectors, private credit managers are beefing up their capabilities to handle workouts and restructurings and to make opportunistic acquisitions. Firms are positioning themselves to act not just as lenders, but as problem solvers for struggling companies within their own books, and to take advantage of opportunities that are likely to arise. These moves demonstrate how private credit is capitalizing on market dislocations, filling gaps left by banks, and adapting to a new era of credit markets. So what does this all mean? From the IACPM's cautious outlook to the ECB's insights on tightening conditions, it's clear we're in a more selective and risk-aware environment. Are defaults likely to increase? The general thesis is no, but 2025 will likely be more of a workout year than a growth one for Europe. The positive AI story is starting to wear thin while we await the promised productivity gains, but private credit's evolution highlights opportunities to navigate this landscape, whether by climbing the credit curve or stepping into distressed debt solutions. As we have highlighted before, 2025 is poised to be a year of differentiated markets and performance. It is important to pay attention to where your risks lie and to be selective. As always, staying informed is key to navigating these complexities. Thank you for joining us on the Credit Compass. If you found today's discussion helpful, don't forget to like, subscribe, and share the podcast with colleagues and friends. And if you have questions or topics you'd like us to cover in future episodes, please do drop me a line at any time. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.